India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. I'm Prashant. With me, my colleagues Surbhi and Mangalam. I'm here in Delhi, actually in Gurgaon, where the Jefferies India Investor Meet is happening. And we hope to get some perspectives after the big decision overnight, which is, of course, the kicking off of the Fed easing cycle. Surbhi, Mangalam, good morning.
Hi, good morning, Prashant. So the event is finally done. An intense volatility, right? It was up, and finally down.
Well, you know, the one thing that I'll be looking at is what is the street expecting now? Largely because 25 basis points with dovish commentary was factored in.
Yeah.
50 basis points with hawkish commentary was factored in. But here's 50 basis points with dovish commentary.
Yeah.
So let's
and
see how
I
it
guess that's
goes.
what unnerved the market. So, Prashant, plenty to go over today.
Oh, plenty to go over today. So, let's just dive straight into it, right? I mean, the big talking point, of course, is what the Fed has done. And it's interesting because, you essentially have a situation where the Fed kicked off the easing cycle. I mean, they went from 0 to 5% from the depths of COVID to the high in 2021, to 22 actually. And then we are, for the first time, starting to cut rates. And they've kicked off in a big way, right? 50, not 25. And the market reaction is interesting. Equities actually went up 1%. They were higher through the course of the sort of statement, the press conference, and then they paired gains, and they gave up those gains later. So finally, the close, the S&P was down about 0.25%. The Nasdaq was up about 1/3% or so. Why is that? Markets essentially viewed the meeting with some degree of hawkishness. Let me explain why. And we'll get to specific points in a bit. The basic sort of, thought process, the thinking from a market perspective, right, wrong is a different matter, but the markets took it like this. Markets thought that these guys are doing 50 basis points, right? So it's a big one. That this 50 straight off the bat in the first cut is an acknowledgement that they're a long way off from neutral rate. The neutral rate could be 2%, 3%, depending on who you ask, but it's a long way off. And that starting with 50, they'd want to prevent any further labor market weakness, get to that neutral zone fairly quickly. But the combination of the Fed sort of dot plots, as they call it, the projections, and the press conference and the commentary from Powell essentially implied that this was, this 50 basis point was sort of a catch-up. It was not something which was, 50, 50, 50. It's a catch-up, and that this should actually have come in July. If you listen to the press conference, they were actually questioned specifically to this regard, and Chair Powell actually acknowledged that. He said that we would have cut in July if he had the July data, the labor market data in July, which kind of sparked off that sort of, market volatility, etc. Now, that essentially is the backdrop and the reason why, if you're thinking, well, 50 basis point rates are coming down, why the market's down, this essentially is the reason. Actually, Powell was very explicit. He said that FOMC is not in a rush. And then at another point, he said that 50 basis points is not the new pace. And that, I think, is what the market really was worried about. So, if you look at the economic projections, they're expecting just 2 more 25 basis point rate cuts this year, which is 50 now, 25, that is 100 total. But at the same time, they've raised their unemployment rate forecast for 2024, 2025, and 2026 as well. So essentially the fear is that, if the labor markets were to soften meaningfully and the Fed cut by only 25, it may not be enough. That is, markets day to day for you, and the reason why, we had a bit of a pullback. Now, the 10-year yield went up 6 basis points to about 3.71. The dollar index, it briefly got to about not 200, but 100.1, 100.15. And then there was a nice move to about 101. Oil prices were down about 1%. We're back at about 70, just under 73. Gold prices hit a new high of $2,600 intraday and then pared back to about $2,550 by New York close. So this is essentially the lay of the land as we begin a fresh trading session. Remember, I would say this, that there is too much nitpicking, and I said this yesterday as well, whether it is 25 or 50. I mean, from that press conference, you can come out feeling hawkish like what the market did, or you can come out with the sort of, feeling that they are ready to do what it takes. The asymmetry in terms of the reaction function of the Fed is very, very large. And, I don't think, despite the commentary, there is any reason to believe that if the labor market were to weaken substantially, I mean, they'd want to be behind the curve. Actually, Powell mentioned explicitly that with this cut, they hope to be sort of in line or in pace with what data shows their way in the future. So I think maybe, just a day-on-day kind of a thing more than anything else. With this small pullback that we've seen, nothing to really worry about. I'll sort of put in the levels here. The Nifty support comes in at 25,313. Yesterday, we had a pullback here as well. That's the 40-hourly moving average. And then you get to the 20-day moving average for the Nifty. And that'll sort of come up on your screens as well. That's 25,133. Bank Nifty was the only index which ended 1% higher, and it closed above the 78% retracement. Yesterday's high of 52,954 is the first level to take out, and then the all-time high, which is 53,357. Remember, Nifty has made its highs and done all that and pulled back a little bit. We're looking at sort of, getting back to newer highs there. For the Nifty Bank, we've not made a new high, so that's essentially the repair that's pending here. Support for the Nifty Bank comes in at the 40-hourly, which is 52,064, and then the 20-day moving average, which is 51,438. The advice is this. I think GIFT Nifty is indicating a 20, 30-odd point higher start. Start of an easing cycle is good news for emerging markets. It will send flows our way, first to the debt market, fixed income, because there'll be interest rate differential. RBI will only start cutting maybe later this year, much later after the Fed, so that interest rate differential is there and it makes bonds here attractive. At the same time, a rate cutting cycle means lower dollar, and that's good news for flows into emerging markets. So day on day, around the Fed, volatility is to be expected. So if you're trading, be mindful of that. But I don't think there is any real big reason to be worried. Actually, it was a joyous cut, right? It was a cut where he said, well, we are happy to do it. Labor market is good. And he had to push back. The point is, if you do 50 basis points and then do not sound optimistic, the market will think that, well, maybe there is something wrong. Maybe there's something that we're missing, which the Fed knows. And I think they wanted to push back to it. So just wanted to sort of make those points. Surbhi, what are you looking at?
Prashant, a joyous cut. I guess despite all the priming with some of those news articles that you were alluding to earlier in the week, despite all of that, I guess they sufficiently managed to confuse the market, right? Because it was up, up, and then finally kind of ended down. But Asia this morning, Prashant, is a sea of green, probably taking that larger cue that, all things put together, because you're talking about a series of rate cuts from the US Federal Reserve. This should just make money cheaper. And net, go back to classic theory, it should be good for risk assets. And that's the simple sort of, analogy that seems to be playing out across Asia. By the way, the Taiwan market will also be considering its own sort of central bank moves today. There's so many central bank moves. Taiwan is going to be looking at the possibility of rates being left unchanged at 2%. They're at 2% right now, and no change is expected over there. Speaking of the dot plot, just to quickly remind everybody, in case you missed all the dots and where they point, what the Fed essentially is saying that, that they'll do another 50 basis points this year. So 50 plus 50, that's 100 basis points this year. Another 100 basis points next year, that's 2025. And then 50 basis points in 2026. So that's what the dot plot is telling us right now. Coming back to Japan, that's the other interesting one, because the Bank of Japan central bank meeting has kick-started today. It'll conclude tomorrow. And remember, it was the BOJ that really got markets in a topsy-turvy ride in July with that rate hike, that surprise 25 basis points rate hike they did. Well, right now the expectation is they're not going to go on that hiking curve, especially when the Fed is cutting. They'll just stay pat, at least in this policy meeting. The Nikkei, by the way, is surging. It's the best performing market in Asia right now, the gain of well over 2.5%. The yen is something to watch, because despite all this, despite the expectations that the BOJ is not going to be hiking rates, the yen has continued to strengthen. In the last 1 month also, it's up about 3% against the dollar. It rose to as much as 140 to the USD. It's pulled back a little bit, still around 143. So the yen is something to watch for. And I was reading some commentary. Citi, by the way, on technicals is saying that the yen can keep strengthening. It can even go to 130. So let's see. That was an interesting outlier view. So thought I'll put that on the table as well. More central bank actions. Taiwan, I mentioned today, is expected to leave rates unchanged. Ditto for the Bank of England. Not expecting any rate moves there either. Let's come back home then. Of course, the critical question is going to be whether this thesis that was playing out in the market yesterday, that, global central banks have started moving, what next? RBI will eventually cut rates, so it's good for lenders. Whether that will play out today as well, whether that is a sort of start of something new on banks and financials. So let's watch out for that. The other aspect, of course, is IT. Let's see if IT can recover after yesterday's big drubbing. So those are big trends to watch. In terms of flows, FIIs were buyers. They bought, cash equity worth nearly 1,200 crores, 1,150 to be precise. Domestic institutions, much smaller figure yesterday, a buy figure of about 150 odd crores. As usual, once the central bank headlines get over, it's going to be all about individual stocks, and there's plenty to keep us busy. Just a sampling. Yesterday, you saw the move in fertilizer stocks at the end of trade, and the news was coming in as we were closing out that the cabinet has approved almost 25,000 crores worth of nutrient-based fertilizer subsidy. Let's see if there's any follow-through today. Mangalam tells us that in Andhra, there's good news because the government there is looking at a new, liquor policy, which basically will allow sale of liquor at the retail level by private companies. This might be good for, and we've seen that in some of the stocks already, the build-up in stocks like Radico Khaitan. More on this as we go along. Nazara is raising money, almost 900 crores. Irida, if you remember the management's conversation with us earlier this month on the channel itself, they were saying that they want to raise money, equity, and it will all rest on how much equity the government is willing to dilute. We have the answer now, and IRIDA is looking at a dilution. The government of India, it's holding in IRIDA. They're looking at a dilution of up to 7%, so that's a stock in focus. And GETND, big, business restructuring underway, because of which the promoters could be selling some equity. So, like I said, Mangalam, short point, I think beyond the central bank headlines, individual news flow, there's enough to keep us busy today.
I'll just keep an eye out on three things, Fed or no Fed. One is the tug-of-war between IT and banks. So if you just pull up yesterday's contribution chart, it looks like two cricket teams. One of the batters, the others are the bowlers. You have Infosys getting beaten, TCS, HCL Tech, all of them dragging the index. On the other hand, you had HDFC Bank, ICICI Bank, all the financials doing extremely well. The second thing I'll be watching out for is how the market breadth behaves, because for 2 days running now, we've seen more stocks decline than the number of stocks advancing. 1,500 to 1,700 stocks on an average over the last 2 trading sessions have been on the losing side. And the third thing I'll be watching out for is what happens to the volatility index, because after declining for all of last week, the India VIX saw a sharp spike in yesterday's trading session to the tune of almost 6% odd. So what happens to that once the Fed event is out of the way is something we'll be watching out for. On the Nifty Bank itself, yesterday was an outperformer. Could it have, done a lot better had it not been for the weekly options expiry? Because 53,000 calls were written, quite aggressively. So maybe there was some resistance out there. Now it's perilously close to that previous record high as well. So yesterday it went about 300, 400 points close to its record high. And today, with the rate sensitives being in focus once again, can the Nifty Bank do better? Because that's what the FIIs believe as well. They've been buying in index futures, but they've been buying in Nifty Bank futures. If you look at the FII net buy, yesterday was 1,400 crores. They bought 1,600 crores worth in Nifty Bank, and on the Nifty, they actually sold 200 crores. They're net long to the tune of 69%, and they've increased their long exposure by almost 1 lakh contracts. So that's something we'll be watching out for. Also, it's a Thursday, so it's Nifty weekly options expiry. Do not lose sight of that range as well. 25,500 call writers, pretty active, telling you that 25,550 thereabouts could be a bit of a resistance. If we do manage to cross that, then there has been a lot of punt buying at higher levels as well. But at the lower level, support comes in closer to 25,200 to 25,250. Prashant.
Well, that's a nice summary of everything you need to know as we kick off this day. Mark Giannani and Arvind Sanger are with us to take some questions on what they made of things. Gentlemen, great to have both of you here. Thank you very much for your time. Mark, let me start with you. The market reaction yesterday maybe is what flummoxed some people, or maybe the commentary, and of course what led to it, as I said earlier, is Powell saying that 50 basis points is not the new pace and kind of painting a rosier picture of the economy. In that sense, I mean, rate cuts which are needed by weak data are bad news, but you don't have that weak data and you get a 50 basis point cut. It's kind of the best of both worlds. Would you be inclined to view it that way? What's your sense?
Thank you very much. Good morning. Absolutely. I think the overall economy in the US is still doing really well. I think growth is still very solid. GDP growth in the second quarter was 3%. In the third quarter, we expect something north of like 2% in real terms. So pretty solid growth here, still supported by consumer. So then the question is, why is the Fed cutting? I think the Fed is cutting because it sees that inflationary pressures have really come down, that they feel confident that inflation is turning and returning sustainably towards the 2% target. And at the same time, the labor market, which is the other side of their mandate, seems to be at full employment, but is easing, is cooling. The labor market is cooling, and they want to make sure that they keep it near full employment where it is, and not that it gets into more weakness. So I think what we saw today is really on the part of the Fed an effort to recalibrate their policy stance by really bringing down the funds rate to a level that's more consistent with the easier labor market conditions and also the lower inflation, and make sure that they don't endanger the labor side of their mandate.
Fair enough. Arvind, what is your sense? I mean, ultimately the question is, what does it mean for markets from here? Can it provide fresh impetus to global markets? I mean, India has, of course, been a league of its own, a clear outlier in that sense. But all said and done, it's a, for the lack of a better phrase, it's a happy cut. I mean, it's not a sad cut. Go on, Arvind.
Yeah, well, I think that's an interesting way to put it, happy cut. I can't disagree. I think the reality is that 5.5% is a tight condition for where the long-term neutral rate may be. The long-term neutral rate may be, 3.5%, 4%, as the Fed sees it right now. And 5.5 is clearly tighter conditions, and with inflation rapidly diminishing and maybe closer to 2.5%, not quite 2%, but at the same time unemployment rising, the risk of staying too tight too long is the risk that we could tip the economy over into recession. Clearly, right now the economy is not looking that weak, but it could weaken if the financial conditions remain tight well past the neutral rate. So that's why I think the Fed may be admitting that that they might be a little behind the curve and they should have done 25 in July and 25 now. They didn't explicitly say that, but I think that's what is implied by this 50 basis point cut in one shot, is to make sure that the financial conditions get towards neutral much faster. And the other question, I think that helps global liquidity, yes, markets and risk capital.
All right, so then that begets the question, what happens to emerging markets? The US cuts rates by 50 basis points, with 50 basis points slated for this year as well. So where do you see emerging markets headed as a result of this? And on that, India itself, I mean, it's already run up. People are talking about valuations at one extreme here. Do you see this as an incremental positive for India or incremental positive for emerging markets ex-India?
Well, if I were to answer this, I would say that if you look at the US market today, the best performing part of the market was the Russell 2000, which is the value part of the index, not the growthy part, NASDAQ. India is like the NASDAQ. Other emerging markets may be more like the Russell, more value parts. So on a relative basis, I would say the value out of favor may benefit at the margin more than the momentum part of the market, which is India. But it doesn't mean that money will not flow into India or to emerging markets in general. So I think India will benefit, but I think some of the laggard markets may be the bigger winners if financial conditions ease rapidly, as the Fed futures are indicating.
Mark, hi, great to be having you in the conversation today. Let's talk about other asset classes as well. I mean, what does this rate cut cycle mean for commodities? Because that really ties into what we can expect on inflation next. And also, throw in a word on the other major central bank, right? Tomorrow, we're all watching out for the Bank of Japan. And I think the expectation is that at least tomorrow they won't do anything. But a section of the market still believes that if they need to hike, they will, irrespective of what the Fed is doing. Would you agree?
Yes, I mean, I think whereas for the US, there was a lot of uncertainty about whether, in fact, they would do 25 or 50 basis point cut. I think that, people over the past week have really moved around that these expectations quite a bit. But I think overall, the path for the funds rate is pretty clear. The direction is downward. The question was, 75 basis point by the end of this year, 100 basis point by the end of this year. Now it looks like it's more going to be 100 basis point at the end of this year with another 25 basis point cut in November, another 25 basis point cut in December as based on the SEP. But broadly speaking, this is not really changing the market expectations. So whatever the commodities we're pricing in and the other central banks were pricing in is not radically changed by this new policy decisions today, irrespectively of all the uncertainty that we've seen over the past week. I think what's pretty clear is that the Fed is going to be cutting more. It's going to be. It made very clear this, I think, today that it's not going to cut rates at a very rapid pace. It's no longer going to do 50 basis point. It's more like in the 25 basis point range, unless we see a very substantial deterioration in the labor market. And so I think in that respect, they project an economy that remains quite resilient, continues to grow solidly. That's going to be favorable for overall global economic conditions and supporting the world economy as a whole, as well as commodities as a whole.
Sure, Mark, that point's well taken. So if this continues to be a gentle rate cut cycle, then I think the markets will absolutely love that. But just finish the other point on the BOJ as well. Do you expect the BOJ to continue hiking? And if that happens, then, I don't know, what precedent do we have where one major central bank is cutting and the other is hiking?
Well, they still have a large discrepancy in terms of rates, in terms of levels. And there are different stages of the cycle. The Bank of Japan is also dealing with inflation at a different cycle than the US. So, as part of where they are going, they may converge eventually, but for the time being, they may well proceed in different directions.
All right, gentlemen, thank you very much. Great to have perspective from both of you today. There's plenty to think about and plenty to discuss, and we'll keep doing that over the course of the coming weeks as well. The new rate regime has only just started. Well, with that, we have to take a very quick break, come back on the other side, and of course, we have to boil this down to stocks as well. All the individual movers and shakers that you need to keep your eye on this Thursday morning. Back in a moment. For what it's worth, the color is a bright green across most Asian markets, and the anticipation is that we'll be in step. We'll start off positive. I'll get the implied open up for you. There we go. 80 points pop is what that level is suggesting. But what about individual stocks? So, well, let's straight away get to the CNBC TV 18 list of top stocks to watch this morning. Our team is standing by. Guys, morning to all of you. And Vivek, let me kick it off with you. Congratulations. You got that NTPC story bang on, and indeed, the IPO of the renewable energy arm is finally happening?
Well, absolutely right. In line with what we reported a couple of days ago, NTPC's 100% wholly owned subsidiary, that is NTPC Green Energy Limited, has gone ahead and filed the DRHP to go ahead and launch an IPO. Now, as per the DRHP, NTPC Green is looking to raise close to 10,000 crore via a fresh issue of shares. What is the company raising 10,000 crore for? As per the DRHP, there will be a repayment of close to 7,500 crore that will be used for debt repayment for its subsidiary, that is NTPC Renewable Energy. Now, talking about the FY24 financials, revenues of close to 1960 crore, an operating EBITDA of close to 1750 crore, and a profitability of close to 345 crore is what this particular subsidiary, that is NTPC Green, did. What is it that they have in terms of capacity? 3.3 gigawatt of capacity is what they have, and the company actually has a plan to go ahead and commission close to 20 gigawatt of capacity by FY27. So very strong pipeline as far as the capacity is concerned, and NTPC will be able to unlock value. Markets were knowing it, and the management also had guided for this particular development at the end of the Q1 call.
All right, take that point, Vivek. NTPC will be the stock, and congratulations once again for getting that story right as well. But let's talk about the alco-bev companies. You have seen a big rally in a lot of these alco-beverage companies for the last many trading sessions, and now we know the reason why. It was expected, and now it's formalized and passed by the Andhra Pradesh State Cabinet, where they've approved a new liquor policy which starts from the 1st of October for the next couple of years. And this is a policy that facilitates retail sale of liquor by private players, and also price of select liquor brands will be brought down to 99 rupees per quarter. Positive for a lot of these mass brands and not just the P&A brands itself. Remember, a couple of weeks ago, we did have the management of Tilak Nagar Industries join us. Remember, they get almost 50% of their sales from Andhra, Telangana, 30% coming in from Andhra. They said that if the new excise policy in Andhra is announced, volumes can grow by 8 to 10% compounded over the next 5 years in this geography itself. We spoke to analysts as well, and they've said that Andhra policy can actually grow volumes by 7 to 8% for alco-bev players for the next couple of years at least. And FY26 itself, there could be a volume growth of 14 to 15% for beer and 10 to 12% for prestige and above players as well. Is that in the price? Well, who's to say? Because if you look at it, over the last 1 month, United Spirits is up 10%, Tilak Nagar up 32%, players like Radico and Global Spirits up anywhere between 33 and 51% itself. So a large part of that was expected, but going forward, going into the festive season, etc. as well, we can see some green in all of these liquor stocks continue. But talking about one confirmed story from Vivek to another one from Rachna. Rachna, you spoke about Nazara Tech going ahead and increasing, the funds or adding to their fundraise portfolio, and they've done that.
That's right, Mangalam. It is a CNBC TV 18 Newsbreak confirmed. We had reported earlier in the day yesterday that the company is looking to raise funds via a preferential issue, and that's exactly what the company announced later in the day. This is a 900 crore fundraise, and as per the company statement, these funds will be allocated towards more acquisitions. Now, the company had recently acquired and actually made the biggest acquisition with PokerBaazi just last week, and it was on our channel that Nitish Mehta Sen confirmed that funds from this fundraise will be allocated towards a part of a payment for that particular transaction. Apart from that, the company has now announced hiking of their stake in their subsidiary Sportskeeda. Now the company holds about 91% in Sportskeeda after acquiring 20% more yesterday at a value of about 145 crore rupees. 45 crore rupees. But that's not all. From what we've learned from our sources is that they're further trying to acquire and foray into the offline entertainment and games business along with publishing business. So these are the new sectors within the gaming sector that we could see Nazara entering in the near future.
Okay, quite interesting. Thank you very much for that, Rachna. Let's head across to Vamakshi now. She's watching out for a bunch of stocks, including, I think, GE, TND, Irida, and All Cargo as well. So that's a big list. Take it away, Vamakshi.
Well, good morning, Surbhi. Let me first start off with GE TND. The promoters, Grid Equipments and GE Grid Alliance, have announced a proposed OFS. Keep in mind that the company back in August had intimated that the promoters were reviewing the shareholding structure to simplify the holding structure of the company. The promoters have announced that they will be looking to offload nearly 11.7% stake. They also have an option to upsize this stake sale by almost 3.9% to 15.6%. in case of oversubscription. The floor price for this has been determined at 1,400 per share, which is coming in at a steep discount of 18% to the closing price yesterday. The OFS opens for non-retail investors today and for retail investors tomorrow. But given that it is coming at a sharp discount to the closing price yesterday, and the stock itself is trading at premium valuations, going with a red for GE TND. The next stock that I'm watching out for is Irida. The government has approved dilution of up to 7% equity in the company via QIP. Keep in mind that the company had received an in-principle nod to raise 4,000 crores back in August, and the government currently owns around 75% stake in the company. So given the stake dilution, going with the red for IRIDA. All Cargo Logistics, on the other hand, is expected to see a positive start to the trading session today, and that is because the August less than container load volume is down nearly 1.1% month on month, but up nearly 5% YOY. The volumes are expected to remain upbeat till the third quarter of this calendar year. They also witnessed an increase in volume for LCL in Latin America, Europe and Middle East. Container utilization, on the other hand, has also seen a good improvement on the back of increase in volumes. August FCL, that is the full container load volumes, were up nearly 4% month on month, 10% YOY, and this is the highest ever monthly volume that has been posted. So given those developments, going with the green for all cargo.
All right, take those points. Mamashi, thank you so much for that. Vivek, let's wrap it up with all the other stocks that are in the news this morning.
Well, that's right. Quite a few stocks on the back of news flow that will remain in focus. First up, Power Grid. The company has emerged as a successful bidder under the BOOT model, that is a build, own, operate, transfer model. This is to establish an interstate transmission system in Rajasthan. So from a substation in Madhya Pradesh, there will be a transmission system that will be set up, and Power Grid has emerged as the lowest bidder over there. The second stock on the radar is Garden Reach Shipbuilders. On June 22nd, 2024, the company had received an order for 4 vessels from 2 German companies. Now, what's actually happened is that there has been a confirmation of another 4 fresh vessels that Garden Reach has received an order for. So the total order value is at close to $108 million, and this is something that will lead to a total multipurpose vessel capacity of 7,500 deadweight tonnage. Lastly, Restaurant Brands Asia will remain in focus. Yesterday, you saw a large block deal take place over there. So the promoter entity, that is QSR Asia, which is a part of Everstone Capital, sold close to 2.16% stake in the company at 105 rupees a share. The entire share, stake sold yesterday was picked up by Mirae Asset Mutual Fund. Remember, Everstone Capital held 15.33% in the company at the end of Q1.
All right, got that, Vivek. Thank you very much. So plenty of stocks on the radar. Let's quickly recap the list of stocks to watch, the ones that have positive news flow around them. Are NTPC, United Spirits, Radico Khaitan, All Cargo Logistics, Power Grid, Garden Reach Shipbuilders, and Restaurant Brand Asia. Stocks with negative news around them are Nazara and GET&D, along with IRIDA. Okay, so that is the stock-specific action we are watching out for. Let's look at the world of commodities now and how they have digested this 50 basis points rate cut. Manisha is joining in with the latest. Good morning, Manisha.
Thank you for that. To be well digested and done with. When you look at the gold prices, we did see a knee-jerk reaction. The gold price has hit an all-time high at $2,600 an ounce. But then you saw the dollar index and bond yields gain as the U.S. Fed started to give future guidance. So Powell did say that Fed is not in a rush to ease policy, and 50 basis points is not the new pace. And that really led to profit-taking, so much so that the gold prices fell $40 as Powell was speaking. But markets will now watch out for the Bank of England, Bank of Japan monetary policy meeting that is in this week as well. For gold, it also is about the Western investors buying it quite at quantity. Not just gold, that is exactly what we saw happen in the industrial commodities as well. So initially there was a run and a rush on the higher side, but after that the crude oil prices came off as well, and we saw prices decline 0.5% overnight, and that's exactly what the metal prices also did. Zinc slipped 1% overnight, so was the case with copper. Aluminum fell 0.5%. The markets this is a reaction to the Powell testimony, and also the Chinese data has been on the weaker side, and that started to take over as well.
Right, Manisha, thank you so much for that. We'll keep an eye out on all these developments out here. We'll take a short break for now. On the other side, we'll have Siddharth Khemka of Motilal Oswal Financial Services joining in for some fundamental stock ideas. Welcome back. You're watching us here on Bazaar Morning Call. The GIFT Nifty has expanded its jumpstart now 88 points. Remember, when we started the show, it was up almost 25 points. So as the street comes to terms with the US Fed rate cut of 50 basis points, we'll see an impact of that on our markets as well. But what are the individual stocks that you need to keep on your radar? Our team has told you that, and now we have some fundamental ideas coming in from Siddharth Khemka, Head Research, PND at Motilal Oswal Financial Services. Siddharth, good morning. Yesterday, the toast of trade were the financials. Bajaj Finance also ended higher. So you had banks, NBFCs, both of them do well. With the overnight developments in the US, do you think the pressure on the RBI to cut rates earlier comes by, and as a result of which financials becomes a good trade?
Hi, morning, Mangalam. So yes, I think the 50 basis points rate cut definitely puts a pressure on not only our own RBI, but a lot of other global central banks to relook at their monetary policy going forward. As we could see, there was a lot of confusion post the rate cut and the Fed commentary. So while some of the emerging markets did cheer the 50 basis points rate cut, there was also a concern on the thought that there could be a recessionary pressure or a growth slowdown in the US markets, which could lead to pressure on a lot of other sectors as well as other economies. Having said that, we definitely think NBFCs do make a case here which tend to benefit from the rate cut or the interest rates going down directly, and also some of the financials like banking sector also benefit, but that will be with a lag. So the immediate effect will be on the financials, the NBFCs within which we like something like a Cholamandalam Investment and Finance, which has been in the forefront of growth across segments that it operates in. Shriram Finance is another stock that we like from the NBFC space and which has been doing well even after the inclusion in the Nifty index. Some of the other themes within the broader NBFCs, for example, the capital market theme that continues to do well. Some of the asset management companies, I think that will continue to do well in the near term.
Okay, Siddharth, hi, good morning, great to have you on. Let's straight away get to this whole Alco-Bev space, right? Mangalam's been telling us that the policy is changing in Andhra, and I think some of the estimates say that maybe volumes across the sector could go up by 7-8%. Do you like anything here? Radico, United Spirits, any favorites in the entire segment?
Morning. So if you look at from within our coverage, we like United Spirits. That is one stock that we have been liking for some time now. There has been a clear shift from the executive segment to the premium segment, where there has lead to an improvement not only in the overall growth but also in the margins. And hence, I think the changing policies across states, that should be positive. One clear trend that has come out in the last few years is some of the brands that the Indian alco beverage companies have been able to launch in the global spirits market, and that has been well received. So that has helped some of the smaller names. Also, the ethanol blending, where some of these alco beverage companies do produce and are able to contribute to a growth as well as getting a good margins from the ethanol in the OMC blending space. So overall, that space looks interesting. The consumption of alco beverages has gone up in India with the urbanization, with the higher spending capacity. And as I said, within that space, we like United Spirits has been the market leader and is now again back to gaining market share in India.
Right. And a word on IT. Yesterday was an underperformer. The street believes that, if the US sees some weakness in its economy, our IT stocks could bear the brunt. Anything that you like or dislike here?
Yeah, Mangalam, I think that's a fair assumption to go by now, given that the mixed chatter, especially in the US economy, economists there talking about a slowdown. The slowdown brunt will be first borne by the IT companies. So we'll have the pre-quarter update starting coming in sometime later during the month, and I think that will give more insights. But for now, I think sentimentally, after the run-up that we have seen in the Indian IT space, they could see some profit booking and some negative sentiments with regards to the IT space. But if you look at TCS, something that we like is more diversified in its client presence. Growth has been very strong, better than even Infosys. And in this volatile environment, we believe a market leader like TCS could do well. So any dip in the next few days could be an opportunity to add to a market leader like TCS.
Okay. All right. Stay on. We'll come back, Siddharth, in just a bit with some more questions. Let's also go across to Anuj and get a sense on today's trading setup. Anuj, the US markets might have been confused, up, down, but I think Asia is giving a very clear verdict. It's just all green. What does it mean for us?
Absolutely, Surabhi. I think this is a perfect scenario, and I think that's what the Asian market is reacting to. You've had a hawkish cut, a 50 basis point rate cut, along with the fact that the next few rate cuts will be, slower and lower. And Surabhi, the data that you were presenting yesterday, I think was fascinating. The next day after the 50 basis point rate cut, normally Nifty rallies on an average 1.6%. And regardless of rate cut or rate hike cycle, the market rallies big in India. Anyway, that's for another day. The US market did see some profit booking as was expected after a 50 basis point rate cut. But for the market, this is a Goldilocks scenario. You have the US economy, which is resilient with no fear of recession. There might be a bit of a slowdown. At the same time, there's going to be rate cuts. So I think that's a big positive. The other factor which got missed this morning was the dollar yen. Yesterday we were talking about 140 being breached again. This morning we're at 143.15. It's a massive rally which has happened here, which has sort of ended the risk or lowered the risk of carry trade unwinding for global markets. So that's another positive. My sense is IT stocks could rally big today because yesterday's reaction to Accenture, I think, was overstated. And also the market wanted to book some profit ahead of this Fed event in the IT stocks. The Bank Nifty, in any case, is showing signs of hitting an all-time high after the consistent underperformance. So that's also another positive. Coming to levels then, on the Nifty, the first resistance I'm watching out for is 25,450, 25,500, which is perhaps where we begin, going by the GIFT Nifty, the all-time high. And then today's weekly expiry, 25,558 to 25,633, based on the options data. The support, of course, comes in at 25,250 to 25,300, which was yesterday's low. And then the bigger support is 25,150 to 25,200. Last Thursday, when we had that massive breakout, it was from this level. On the Bank Nifty, which has been one shade better than the Nifty, it needs 1.1% move to hit a new all-time high. The first resistance here would come at 52,900 to 53,000, and then, of course, the all-time high. Support at 52,400 to 52,500, and then 52,100 to 52,200. It's for the quote of the day. Since it's election season and since it's US, which are both in focus, I have combined the two. Benjamin Graham once said that in the short run, the market is a voting machine, but in the long run, it's a weighing machine.
Okay, all right. Interesting thought. Really, voting machine, but in the long run, it's a weighing machine. And let's see how it comes out on top. Thanks very much, Anuj, for joining in with that. Well, with that, let's just go back to Siddharth. I think Siddharth is still with us. Yeah, I think Siddharth is still with us. So, Siddharth, back to some more stocks, some more questions. I don't know if you track GE T&D in any detail, because there is a big restructuring that's happening. I think promoter level reorganization, because of which there'll be some stake coming in the market as well. Any thoughts?
So I don't track it that closely, but if you look at, I think across the capital goods space, some restructuring that the company is planning. The last few quarters, we have seen strong order book run up across capital goods, and that should help. But beyond that, no views on GT&D.
Do you have a word on NTPC because of the unlocking in their renewable business? I mean, everyone's looking at renewable as a theme. Everyone's seen PSU's rally as well. This one's an amalgamation of two, renewable plus PSU. One would imagine it to be pretty good, but at the same time, we're in a bit of a profit booking mode for all these PSUs. So do you think it's a little late in the day, or do you think there's still value to be unlocked here?
So, Mangalam, I think this news was there in the street for some time now that NTPC is in the works to file the IPO for its green business, renewable energy business. Having said that, we are positive on the core business power sector, where we see consistent growth in demand, and with the economic growth continuing, especially on the manufacturing side, we see consistent improvement in the core business growth, and that makes us positive on NTPC. The renewable side is something that we are also positive that the street has been waiting for the value unlocking to happen, because so far what we have is some of the small players in the renewable space, and this will be the first large renewable company that will come out. Even some of the other utilities, for example, you have Tata Power, they had divested some stake in their renewable business. That should also look up after this. So I think this is a positive development, and the value unlocking will only create more interest in a lot more towards these power utilities which have a subsidiary or a business in the renewables. So overall view on NTPC is positive.
Okay. All right. Got that, Siddharth. Well, on that note, we do have to take a very quick break. We'll come back on the other side. Mitesh as well as Sudarshan Sukhani are going to be with us. We'll get to some technical trading ideas today. Back in a bit.
Okay, welcome back. If you're just waking up and you've not seen any of what has happened in the last, 10, 12 hours or so, the Fed has cut interest rates, 50 basis points. Markets in Asia are higher. In the US, there was a bit of a pullback. But as we've been saying, don't fret too much about it because, it's looking pretty all right. The economy is pretty strong and you've got a large rate cut to kick this off. Let's bring in Mitesh and Sudarshan with us to run us through specific trades and what the risk-reward looks like, because that is the issue, risk-reward. It's not just here in India, but both India and US have been really world beaters in terms of returns out there. So how do you trade this one is the question. Mitesh, let me start with you. What's your sense? Yesterday we had a bit of a consolidatory kind of day. Nifty Bank, though, was up 1%, the only large index which was up in that sense. What do you do this morning?
Morning, Prashant. So, a couple of days we have been highlighting that the financials and the banks will cover up for the underperformance. And while the Bank Nifty met the target of 52,800 and even went past beyond that, I think today could be a more quieter day, a day of pullback with some choppiness. The Bank Nifty also is now at supply levels of 52,900, 53,000 zones. And Nifty, I think, is not clearly showing momentum on the upside. With the IT pack breaking down, I think it would be a slightly negative day. So today we'll approach the markets with a mixed bias. I have both buy and sell calls. And on the Nifty, maybe around 25, 250, 280 zones is where I think if we get it, then, we'll want to go long. Otherwise, we'll wait it.
Okay, all right. Sudarshan, how would you approach things?
Yeah, good morning. See, the market is in an uptrend. We have to understand that basic fact before we discuss any market action. In an uptrend, the trade is to go and buy. Now, because it is in a consolidation, there's no rush to buy the Nifty or even the Bank Nifty today. We wait patiently. The markets can chop around and consolidate for more days than we imagine. That is a likely scenario. So inside a consolidation, wait for a patient 80 to 100 point dip from the opening price. If you get it, go long in the Nifty. Don't think about it. Just keep a 100 point stop loss from your entry and be long. If you don't get this dip, then just avoid the day today.
Okay, all right. Sudarshan, what would your specific trades be?
Well, there are a lot of stocks that are giving good signs. M&M is a buying opportunity with a stop under 27.70. My only intraday short is TCS. I would think it's sacrilege asking somebody to sell TCS. So be careful, but it's an intraday short with a stop above 4,500. I'm repeating, it's only intraday. L&T is a buy with a stop under 36.80, another large cap. And finally, one more large cap, Dr. Reddy's is a buy with a stop under 6,500. Broadly, the theme is there is sector rotation going on, stock rotation going on. There are stocks that are now coming out from small corrections. Look for them.
All right, M&M, L&T, DRL longs, and TCS a short, but only for the day. Sudarshan, thanks for that. Mitesh, what about you?
I have a buy on Nestle with a stop at 25.60 for targets of around 26.85. Aditya Birla Fashion is a buy with a stop at 329 for targets of 345. A sell on Godrej Consumer with a stop at 1450 for targets of 1400, and a sell on Container Corporation or Concor with a stop at 940 for targets of around 900 or just below.
All right, gentlemen, hang there. We'll come back to you in about 45 minutes odd as well. Take a short break, come back. We'll have the pre-opening rate, and also with us will be Karan Taurani of Elara Capital to focus on the Alcobev companies after the new liquor policy in Andhra Pradesh has been cleared by the cabinet, comes into force from October 1. Stay tuned. Right, 10 seconds to go for pre-open, 15 minutes to go for the market opening right now. The GIFT Nifty is suggesting a positive start itself. In fact, if we wait by for about 2 more seconds, we'll have the early rates of pre-open coming in as well. We'll wait by for them to settle, and rates that have come in so far from the pre-open, we need for them to settle. The Sensex is indicating a 1,000-point uptick, the Nifty lower. It's all over the place. Individual stocks are actually doing a lot better in pre-open. It's the IT pack which is seeing a bit of a bounce back. So we have, Tech Mahindra, which is up 2%, Infosys up around 4% in pre-open. And we are seeing some traction in a couple of these, names, stocks which have news backing them as well. Case in point, something like, an Oracle Financial Services, which entered F&O band. We have REC, Pidilite, all of them up and about in today's trading session. And TPC too was mildly higher in pre-open. We'll wait for the rates to settle. Good time to get in a quick F&O check on the market as well. We do have with us Chandan Taparia joining in. Chandan, yesterday was a tug of war between the IT and the banking stocks. The Nifty, as a result of which, ended mildly lower. Today, we have the Nifty weekly options expiry. What are your thoughts?
Good morning, Mangalam. Thanks for having me. So we have seen a small decline in Nifty, but Bank Nifty was holding well on the last trading session. First, talking about Nifty, it has been consolidating in a range of 200 points in between 25,285 to 25,485 zone from last 4 trading session. We have noticed that every small decline is being bought. However, some sort of consolidating move was there as we were expecting the comment from the US Fed. But now, after the key event, we believe the momentum could continue in Indian market, may see the next leg of rally. So major trend is positive, and till Nifty holds above 25,285, overall bullish resistance could continue and index can head towards 25,500 to 25,750. Looking at the data internal, we have seen hold of put call ratio and volatility index is holding below 13-14 zone. So both the data setup indicates that buying interest could continue. Talking about Bank Nifty index, Bank Nifty has been outperforming the Nifty index from last 4-5 trading session. It has been making high tops, high bottom on daily scale, and it is just 600 points away from its all-time high of 53,357. So now hold of 52,250 could take the banking index to higher zone led by short covering, and which may accelerate the up move towards 53,357 in higher levels. Looking at the stock specific, positive on the Motherson, Samvardhan. We have seen that selective auto counter has seen a good momentum, including Motherson, Bajaj Auto, Hero Moto, Escorts, M&M. And here we like Motherson. The stock has given a classical breakout from a bullish pole and flag pattern, which indicates that momentum could continue. And this pattern breakout is happening after the consolidative move of last 13 weeks. So momentum could be seen. It has seen the open interest addition of around 20% in the series, which clearly indicates build-up of long position. So one can buy with support of 199, and Motherson can head towards 214 level. Second trading area, there is buy on ICICI Bank. We have positive stance in banking name. However, IT could see recovery, but banking could continue to see the outperformance. So ICICI Bank has seen the positive momentum. We have seen coal unwinding in 1260 strike. Some short covering was clearly visible in the counter, and the momentum could trigger towards 1340. One can buy with support of 1260. Last trading area, there is buy on MCX. We have positive on most of the capital market name, including exchanges, broking, AMCs, or depositories. So MCX is one of the strongest counter, has been making higher tops, higher bottom. We have seen a major surge in the trading and the delivery volume, which clearly indicates fresh leg of rally. So one can buy with support of 5685, and this stock can head towards 6,000, 6,085 marks.
All right, Chandan, thanks a lot for that. While we're talking stocks and indices, don't lose sight of the currency as well. The rupee is opened 7 pies stronger against the dollar. Of course, it's a function of the weakness that we've seen in dollar index overnight, largely on account of the rate cut that was announced by the Fed. And over the last few trading sessions itself, the rupee has been strengthening from levels closer to that 84 mark. Now it's strengthened closer to 83.68 itself. But let's put focus back on the stocks. Andhra Pradesh cabinet has cleared the new liquor policy. The new policy will facilitate retail sales by private players, will bring down the prices of select brands under rupees 99 per quarter, and also we will have the policies which are pretty similar to what they were pre-2019 itself. Karan Taurani, who's the Senior Vice President Research Analyst at Elara, joins in now. Karan, the street was expecting this for the longest time. This was on the cards. Now that this has come by, how much more of an incremental positive do you see this for the liquor companies, and who, according to you, would stand to benefit the most?
So I think this is good news for the Alcobev companies, but a lot of this is largely priced in. In terms of potential impact, if you see, I think generally AP in terms of volume contribution, it can boost the volume growth by about 7 to 8% largely for all the companies. Because you will also see negative impact of Telangana state coming in, because of interstate movement. So I think net 7-8% volume growth impact, and assuming that clearly the policy is going to be like Karnataka, which is corporation-based market wherein the retail will be controlled by private, you will definitely see better margins, as compared to Telangana, which means that there have been earnings that are made of anywhere close to over 8 to 10%. And if you look at the stocks, all the three names, UBL, UNSP, and Radico, have moved up in the range of 20 to 40% over the last 6 months. And this has been one of the triggers, for these companies, apart from inflationary pressure coming down, glass prices cooling off, and so on and so forth, and H2 being strong gradually. So I think large part of movement is done. Maybe 3 to 6% kind of a price movement could happen from here on. As far as valuations are concerned, they are largely fair. Most of the companies are beyond our target prices by about 10 to 12%, except for UBBL. So in terms of delta, I think UBBL still has got some more respite in terms of performance. As far as Radico and UNSP is concerned, from a near-term perspective, there's immediate upside.
Okay, so United Breweries, you're saying, could have further upside. Stock's not done much. Actually, if you look at it year to date, United Breweries is up just about 16%. I mean, compare it to the kind of market we are in, Karan, maybe so, that still has some elbow room. Beyond the AP policy, if you were to pick an Alcobev stock right now, would it be United Breweries? Would it be anything else? And you're saying Radico is at risk of near-term decline, is it, because of the sharp rally?
No, I would not say that any of these names would be at risk in some sort of a decline, because there are still a lot of triggers going ahead. So if you look at the ENA prices might kind of move up, which could be a positive impact for Radico. They will definitely see backward integration positive impact as well, and Radico has been our top pick. So we would say one can definitely accumulate on dips, because this Radico is a very good compounding story with very strong volume growth prospects led by brand innovation. As far as UBL is concerned, as I say, why? Because clearly the problem there has been margins. So execution on margins, has been challenging. Q1, which is the strongest quarter for the beer industry, UB did not report a strong volume growth as per expectations because of the elections. And I think, once you see volume growth acceleration, and UB was a market leader in 2019 in Andhra Pradesh. So this is going to add some respite, plus inflationary pressures. Glass prices are seeing a cool off. And glass is a bigger contributor for beer companies. 35 to 40% of their COGS is glass led, and plus you have margin improvement. You could see price hikes in other states like Telangana as well. So UB still has ample triggers on valuations perspective as well. Risk reward is quite favorable, and other names would not be a sell or a decline, but yes, it will be more of an accumulate on near-term basis.
Guys, I've been listening into this conversation on Alcobev and Mangalam. You talked about. So we talked about decline, right? I'll tell you, I'm here in Gurgaon, of course, for the DFT's conference, and you know more. Gurgaon is the land of the big, fancy, glitzy liquor shops, right? I mean,
yeah,
it's filled with them. I mean, you just drive from the airport all the way in. It's and in Mumbai, but I think that's just sort of the size and scale between Delhi and Bombay. You've got smaller shops, although they're getting bigger and fancier in Mumbai as well. But here in Gurgaon, it's another level.
It's an Alcobev discussion, and you say Gurgaon, and thereafter you say no more, Prashant. Everyone understands that. But one of the banes of the Alcobev industry has been that retail outlets, are just 80,000. As compared to all the other consumer products, which are 8 to 10 million. Obviously not equating the two, but one of the wants of the industry has been the ability to open more shops for the industry itself, better distribution.
Okay. Actually, speaking of the triggers ahead, if Karan is still with us, Karan, just to go back to that point that you also made on ENA, because if we're talking about policy developments, and on one hand there's AP, in the last, I think, week, the other news was that sugar companies will now be allowed to use cane and molasses to produce ENA. Does that have any bearing at all on the input price itself, and just purely in terms of margins? What should we expect over the next quarter or two for these companies?
So I think molasses that way does not have a big impact for these spirit companies, because most of these brands have moved to the grain-based ENA. Now, also what came in terms of announcement is that, grain prices are bound to see a cool off in the near term because of increased supply. And basis that, what's going to happen, ethanol, ENA manufacturer companies like Radico, companies like Global Spirits are bound to see a positive impact of this, because over the last 2 years, what has happened is your ENA prices somewhere have been largely flattish or maybe 3 to 4% higher. But the cost of manufacturing ENA has gone up substantially because of higher grain prices. So if at all, grain prices are to see a cool off over the near term, companies like Radico will see a positive impact in terms of backward integration, because they'll be able to manufacture ENA or rather procure ENA for the internal requirement at a much lower price as compared to market averages. So this is bound to have a positive impact selectively only for Radico and not for other players, because other players, outsource ENA externally. But as of now, I think there are no signs of increased inflationary pressure. As I mentioned, glass prices are cooling off. ENA is largely stable. So until unless, we don't see ENA prices moving up sharply, if at all they do, then the positive impact for Radico becomes higher, and it becomes a mild negative impact for companies like UNSP and ABD.
All right, take that point. Thank you so much for joining in, Karan. I'm not sure if you track the lower rung of the liquor companies, so whether you'd be able to comment on that or not. But we are seeing a bigger set of gains coming in for the lower rung of players itself. Case in point, something like Tilaknagar Industries, which gets about 30% of its revenues coming in from Andhra. Andhra and Telangana itself account for nearly 50% of its sales. That stock up around 4% after having rallied about 30-40% in the last 1 month or so itself. Let's get into our 9-10 calls then. Mitesh joins in. Mitesh, your 9-10 pick?
I'll go with the buy on Nestle. I think a very good breakout yesterday. Should head towards targets of 26.85.90.
Okay, all right. Got that, Mitesh. Sudarshan, what about you? Your call for the day?
Consider buying M&M with a stop under 27.70.
Okay, M&M would be Sudarshan's pick. Got it, gentlemen. Thanks very much. Pre-open Nifty is telling us we're starting about 110 points higher. The mid-cap index is also in step with the Nifty, actually slightly shade better if you were to look at it as that. But of course, the key remains to talk about, whether banks will continue the roaring move from yesterday and whether IT will come back or not. The two key questions. But before we hit open, let's go across to Nimesh for the standout brokerage report of the morning. Nimesh, good morning. Which one is it?
Hi, morning, Surabhi sir. Today's standout is on Info Edge. A big upgrade coming in from BofA Securities. So they've upgraded the stock trade to buy from underperform. So technically a double upgrade, and they've raised the target price now to 9,000 versus 51.85 earlier. Now, Naukri has a 70% market share and is a dominant position, and BofA sees no risk to that position. Or there is no major disruption risk according to the BofA note. Now, basic commentary from IT companies as well as their own internal checks suggests that there is a steady recovery in terms of recruitment within the IT companies from current levels. In fact, Info Edge's other businesses, ex of Zomato and PB Fintech, has actually underperformed Nifty and is currently trading at 52 times FY26 price to earning versus the entire internet coverage or trading at an average of 124 times. So there is a valuation comfort. Recruitment is picking up in the IT, and there is no risk to the business as well. So on back of all this, a double upgrade on Info Edge to a buy now, and they've raised the target price to 9,000.
Right, a big upgrade that from 5,185 to 9,000, a double upgrade coming in on Info Edge. Keep an eye out on this stock as a standout brokerage, but also a couple of initiating coverages that have come in on Brainbeast Solutions. You know this company better as the company that runs FirstCry, a recent listing on the bourses. Issue price was close to around 465. The first one is from BofA Securities. They've initiated their target price is 770. The stock has settled 5% higher at pre-open itself. Why is that? Because they believe that FirstCry is well positioned to show 21% revenue CAGR, and at the same time they can improve margins by nearly 500 basis points. What does that imply? The EBITDA would compound at over 57% for the next 3 years. And then you have the optionalities of their global businesses, which is international and global bees, which may surprise positively. We have another initiating coverage coming in from Morgan Stanley as well, and their target price is actually a shade higher than that of BofA Securities. It's 818 rupees, overweight rating. Again, a quintessential play on FirstCry, which has strong distribution, large portfolio of home brands, and also supply chain capabilities. It is an underpenetrated childcare market in India itself. But, going forward, the optionalities of the international business like Global Bees, etc., can do well as well. They expect domestic business to compound at 18%, EBITDA margins improving from 9% to 13%. The childcare business can actually grow by 20% CAGR over the next couple of years, with EBITDA margins nearly doubling from 5% to closer to 10%. That stock doing well, could perhaps be one of the stocks of the day.
Okay, absolutely. Yeah, those are big targets. And this is one of those IPOs that hasn't already gone absolutely berserk in a different orbit. FirstCry has not had such a huge move since listing. So let's see, maybe these target prices will work well for the stock. We're counting down to the open. And in step with the rest of Asia, it is going to be a straight out gap up. 100 points gap up is what we are getting. So to kickstart things, the Nifty closing in on 25,500. There we go. We actually had 25,500 for a bit, back above that level. So what's leading it? NTPC, the excitement around the renewables arm, finally making its way as a separate listed entity. So 2% up there. IT is rebounding. LTI, Mindtree, Wipro, Infosys, TCS. So the entire IT pack is undoing a lot of the damage that we saw inflicted on it yesterday. Bajaj Finance is another stock in focus, up about 1%. Some of the metal names like Tata Steel, JSW Steel, all on the upside. Coal India. So basically commodities are up. Bank Nifty is actually soaring about 0.6%. So no problems there whatsoever. Axis Bank leading from the front with a gain of about 0.7. IndusInd Bank is managing about 1%. Kotak is up in about, let's see what the big boys are doing. HDFC Bank also 0.7% higher. ICICI is a little flat, but the shade is green. And State Bank of India is managing a 0.5% up move. So no problem whatsoever. IT up, banks up. Commodities generally starting on the positive side. Just two stocks on the Nifty actually negative. One is ONGC because of the flip-flop on oil prices. Also, there are some brokerage notes this morning saying that the fall in oil is not working well for ONGC. The market's taking note of that foreign broker note. And the other is Bharti Airtel. It's kind of sitting on the fence, not doing anything. But other than that, you have 48 out of the Nifty 50 on the green side of the screen as we start off. Mangalam.
Well, the broader markets are a bright shade of green. Nearly 1,800 stocks advancing for just about 300 stocks which are declining. And that is something that the street will like in particular because the last two trading sessions, the broader markets had seen a bit of a pain. And among the top gainers, we have InfoEdge, which is the top F&O gainer this morning. And that's largely on account of that big upgrade coming in. Nimesh highlighted that in his standout brokerage note as well. The other one is United Breweries. The Andhra liquor policy actually doing well for not only United Breweries, but a lot of these other liquor companies as well. So we have Tilak Nagar Industries, which is up 5%. We have GM Breweries, which is up another 3%. And a lot of these, lower rung allied blenders, etc., lower down the order, if you look at it, past United Breweries and United Spirits, all these stocks doing extremely well too. What's also well bid in today's trading session is mid-cap IT. So IT is generally making a bit of a bounce back. So you have L&T Tech Services, Birlasoft, FirstSource, all of them bouncing back from lows of yesterday. The other stock that is doing extremely well is Brainbees Solutions. Two initiating coverages coming in on that stock, up around 6%. Ireda is one as well. We're back in that phase where, more supply actually is positive for the stock. Ireda, the OFS news, the street likes that. I mean, it's up 3% right now. And then these market-related plays. CDSL is up around 3%. BSE has opened on the back foot. Let's see whether that dip gets bought into or not after that big rally that we've seen on the stock in yesterday's trading session as well. And rallying for the second day running are the Reliance ADAG Group stocks. So we have Reliance Infra, which is up 5%, Reliance Power as well. There were positive developments when it comes to, their balance sheet improvement in yesterday's trading session. So there was news that stock up around 5%, Reliance Power as well. So generally, way more stocks advancing than the number of stocks which are declining. The mid-cap index doing well. And now, mind you, the Nifty Bank is just about 200 points away from a fresh record high. We've been seeing record highs on the Nifty, the Sensex, the mid-cap index on a regular basis. That mark was eluding the Nifty Bank. And as we speak, maybe just about 100, 200 point uptick on the Nifty Bank. A slight jump on HDFC Bank could take the Nifty Bank to a fresh record high.
Yeah, absolutely. And the way the banks are charging ahead promises to be another good session. Let's see if the gains can be held on to or not, and we can get more follow through. InfoEdge is really surging now. Those two, important notes that we had Nimesh highlight. It's really up in a way. 9,000 was the target price that was put out. The stock's at about 8,100 now, 5% on the upside. The other one is Raymond Lifestyle. The recent carve out, the recent listing from the Raymond Group. Good day today, 5.5% up on that stock as well. And I think the market really heard our conversation with Karan Taurani on Alcobev because United Breweries is actually the best of the pack right now. About 3.5% up. That's one of the stocks that he was relatively even more optimistic on. So looking good. The Nifty retaining a gain of 170 points. Bank Nifty up 400 points. And the mid-caps as well running right in step. Prashant, good morning today.
No, I mean, and I think, yeah, it's a great morning, 170 on the Nifty, and why not, right? I mean, we've got, I mean, a big rate cut kicking off the global easing cycle. Remember, I mean, the thing to remember is that it's not just the reason why we spend a fair bit of time looking at the Fed and what it does, etc., is because, I mean, essentially it's, you know, the largest, most powerful central bank, and whether we like it or not, I mean, it's got a powerful signaling effect for other central banks around the world in terms of the monetary cycle. So in that sense, it's not just the Fed kicking off the easing cycle in the US, but for, I mean, other sort of markets as well. You know, I just want to highlight one or two more names. You guys have wrapped up things. Reliance Infra is the biggest volume-led gainer. So Reliance Infra has been doing well last 2-3. I think today is the third day in a row when you're seeing action here. Stock was $210 on the 13th, and it's at 290, all 300 actually, almost 300 now. So in 3 sessions flat, and today's the third day, it's moved from 210 to 300. So, and that's got humongous volumes as well. You know, AB Capital and HFCL and Garden Reach had some news flow. There was an order there. It's up about 3.5% as well. So, you know, we'll come back to more stocks in a bit. But Nilesh Shah is with us now of Envision Capital. Nilesh, great to have you with us here. Thank you very much for your time. Appreciate it. So the question, Nilesh, is what to do now, right? I mean, where to focus your energies on in trying to find opportunities. And before you answer that, if you can give us a sense whether an easing cycle will provide more impetus for even top performers like the Indian stock market. Go on, Nilesh.
Well, so I think the markets will continue to favor strength. And from a global perspective, clearly India has been the strongest bastion and has been the strongest kind of island, if you may call that, from a global investment landscape. And with this environment of aggressive rate cuts, that should only augur well for a market like India and an economy like India. The reality is that global international investors, foreign investors have been underweight India. India's weight in various market indices has been kind of galloping ahead, and they have not yet been able to catch up with that. So clearly, I think an environment of rate cuts, cost of capital coming down, I think that should essentially trigger them to kind of allocate more to India. So I clearly believe that while global growth could be a concern, specifically growth in the US, and that's what I think the US Fed has highlighted in terms of jobs. So that will be a headwind, but clearly for India, this headwind could actually end up being a very, very strong tailwind. So that plus the strong domestic liquidity are something which will continue to favor Indian market. So to that extent, I think while conventionally a rate cut cycle has not necessarily resulted in a good equity market, but probably this time around, India is probably going to kind of keep behaving differently the way it has over the last couple of years. So to that extent, I think this bodes and augurs well for India.
So what sectors do well, Nilesh, and where will you look for opportunities? Will you look at something which you were not looking so far? Let's put it that way. We know some color on what you own and what you like from our previous discussions, but would you look at something which you were not looking at so far and now you'd want to because of what has happened?
I don't think the investment strategy or the style is going to change materially with this development, Prashant. I clearly believe that the two most powerful themes from an India point of view, which are very long-term structural in nature, are around urbanization and digitization. These two are essentially the most powerful structural multi-year kind of trends, and these continue to be favorites. I clearly believe that digitization still, I think, is being undermined. I think most investors are kind of having a chorus around valuations, but clearly believe that growth and the upside from a business point of view is far going to outweigh the near-term valuations. And I clearly believe that investors are still significantly underweight on digitization-oriented opportunities, online businesses, consumer, fintech. and they will continue to positively surprise for several years. Yes, sure, there will be one or two intermittent quarters where they could have some kind of a patchy performance, but otherwise I clearly believe that that remains the most powerful thing. Similarly, consumer discretionary, I think that's again going to continue to do well. Prashant, also the last 2 or 3 years, a very large part of the government's allocation has gone towards infrastructure. That continues to be north of 3% of the GDP. But in addition to that, what we have seen in recent months is essentially a lot of cash transfers which are going to happen at the state government levels. And these are humongous amounts. I mean, individual states allocating 20, 30, 40,000 crores as cash transfers. That essentially is going to rev up the entire consumption space as well. And several discretionary products are going to essentially enjoy strong tailwinds. So I clearly believe that while we so far over the last 2 or 3 years have been seeing one side of the market perform, which is the capex infrastructure-oriented place, but I think going forward, with falling commodity prices, falling input prices, falling input interest rates, and these cash transfers are going to provide massive tailwinds for the consumer-oriented businesses.
All right, Nilesh, you speak about digitization. And can't talk enough about how big that opportunity is. We have InfoEdge, which is doing extremely well. Brokerages are positive on that. Zomato, we've seen a massive run that has happened, and this morning there were a couple of notes coming in on FirstCry as well. But we can't, have you and not talk about the IT pack, because yesterday it was under a lot of pressure. Now it's seeing a bit of a bounce back from the lows. Generally, the IT index has seen a rally of nearly 30% as well. How do you look at the US economy and Indian IT stocks in conjunction to that?
So Mangalam, I think the entire US economy, I think, is going to go through headwinds for some time. And that honestly doesn't augur well for the big conventional IT services companies. So I clearly believe that that's really not the space to be in. But there are several tier 2, tier 3 IT services companies which are having niche offerings around products, around services. Some of them have built strong AI capabilities, and they will be able to grow at a substantially higher pace versus their the bigger ones in the peer group. So I probably think that this rally should be probably utilized to continuously switch from the large cap IT names, the top 3, 4, 5 names, and move over to specialized tier 2, tier 3, mid cap, small cap IT services and IT product companies. And that probably is the space to continue to be in.
Okay, mid cap IT companies and fintech, consumer tech, the other aspects of technology beyond traditional IT services. Got that, Nilesh. Good listening into you. So, beyond this, I think the other question that people are grappling with is whether the leadership change away from capex, from manufacturing, from that entire side of the market, PSUs, whether that indeed is now well entrenched, if it's truly underway. What would you say? If someone's still holding on to those positions, is it time to book profits? Should you stay away, or should you look at buying the dip? I mean, where do we stand on that entire, massive move that we saw for the last 2 years?
That space surely deserves a much lower weight or a lower allocation. I think if somebody's kind of been there 3 years ago, 2 years ago, or maybe even a year ago, it might actually be a good time to kind of take some money off the table, especially in the conventional defense names or some of these other infra-oriented spaces. And clearly, I think, move towards more of the consumer, the online, the financials. I mean, banks have been a big pocket of underperformance. That might be a good space. NBFCs, HFCs, these are the kind of places where incremental capital allocation ought to be done. In addition to that, even within the overall capex infra space, maybe the ones which are more veered towards the manufacturing side, the semiconductor side, these are probably the kind of areas where one should kind of veer more towards rather than the conventional capex name. So clearly, I think this is an environment which really will call for some tweaks in portfolio strategy. It will call for some kind of reallocation in terms of sectors. So clearly, I think it's time to kind of be a slightly cautious on the capex cycle, on the defense cycle, not because these businesses may not do as well. These businesses will do well, but just that the valuations have gone up so much that they factor in much, much higher growth, which I think may not be possible. They'd probably still grow at 10, 15, 20%, but they essentially will not grow at the kind of pace at which they have been growing over the last 3 years.
What else are you cautious on? Nilesh, what else are you cautious on?
I think that I kind of earlier talked about the large cap IT. I think one that space calls for caution. Clearly, again, for commodities, this is a difficult time for commodities. It will be a difficult time, especially if global growth slows down. Demand, I think, is going to be challenging. There could continue to be more softness in terms of commodity prices. So I think one should be very careful, even with the typical commodity and the cyclical space. Obviously, users, consumers of commodities will do very well, as they essentially will have lower input prices, which could obviously bolster their margins. So clearly, I think avoid producers of commodities and basically kind of be more towards the consumers of commodities.
Nilesh, finally, to wrap things up, I mean, back to a market question, really, and I was just thinking that the last time we got into a US rate cut cycle, I mean, the big ones, let's go back to 2008-9. It was basically in response to a massive crisis, right? Markets had collapsed, and then the rate cuts kicked in, and then 2009-10 onwards, we started getting the market rally. Ditto for COVID. The market fell, there was fear, then the US Fed started cutting rates, and then the market rallied. This time, the difference is that we've gone into the rate cut cycle on a song, on a dance, right? Markets are at all-time highs, whether it's the Dow, whether it's India, NASDAQ, whatever you look at. So in that sense, can the party just keep continuing? Or do you think that there's some risk out there that we've perhaps missed?
The party, I believe, will continue. At least I can say that the India party looks pretty good. We surely have higher growth, we have moderate inflation, and we have stronger liquidity back home. So I think the India party will continue. Just that when these global headwinds, which have started to kind of surface, or you could probably say resurface, there would be breaks in between to this party, and that break could probably be shorter, but could kind of be steep as well. So I wouldn't rule out at any point of time maybe a 5 to 10% correction in the market indices and maybe more correction in individual stock prices. That I think is quite possible, and that's like par for the course, especially if you're essentially looking at a slightly more medium to long-term perspective. So clearly, I think yes, and historically, every year we do have situations where markets during the year correct 10 to 15%. So that possibility can never be ruled out. But clearly don't believe that the India party is over. The India party is essentially still kind of has way more to go before we can say that, we are done with the bull market.
All right, Nilesh, thank you so much for joining in. Always a pleasure speaking with you. India party is likely to continue, far from over. On that optimistic note, we'll take your leave with the news that the market still continues to hold on to its initial gains. The Nifty Bank actually was very, very close to its record high as well, went just within 4 points from that record high before cooling off a little bit. So we'll keep an eye out on how the market pans out, especially in the second half of trade. And as we speak, we'll also, very shortly get all those doyens up on your screen for you in conversation. So it's the JP Morgan India Investor Summit that we will talk about. We'll have Sajid Chenoy, Sanjay Mukim, Kaustubh Kulkarni, all of them talking to us as well about their view on where the Indian markets are and what's the expectation as well. Let's cut across to Lata, who's now in conversation with the JP Morgan Brain Trust ahead of the all-important investor conference on a day where the markets are at a record high. Over to you, Lata.
The Fed has delivered a supersized cut, and EM central bankers, like the Reserve Bank, will now have to face up to a 4.4% Fed funds rate by year-end and as low as 3.4% by end of 2025. So will dollars rush to emerging markets because you earn less on US bonds? Will the Reserve Bank have to cut rates to avert a rupee depreciation? The FOMC has also, remember, lowered the US growth forecast just marginally from 2.1 to 2% for the current year. It has upped the unemployment forecast to 4.4% from 4%. This will mean a slowdown in global growth, or will it? Then which stocks would be best bets for an Indian investor. For a 360-degree perspective on the Indian and global markets and macros, I have with me the JP Morgan Brain Trust. Sajid Chinoy, the economist, Sanjay Mukim, the head of equities and research, and Kaustup Kulkarni, the head of country head in India. They've all been kind enough to come over ahead of their all-important investor conference on Monday. And so here's trying to get everything that foreign investors think about us. But first, Sajid, first things first, the Fed cut. What does this mean? Now is a Reserve Bank rate cut imminent in 2024?
So first, let's talk about the Fed cut. And, our US team had called for a 50 basis point cut, so this is not a surprise. I think what matters more than the quantum of whether this was 25 or 50 is why is the Fed cutting? Is the Fed cutting because the US is on the cusp of a recession? And our answer is no. In fact, if you look at the Fed Atlanta's nowcast, growth in the third quarter in the US is tracking 3%. The consumer is extremely solid. So the Fed moved because the balance of risk has now changed. They're much more comfortable that inflation is heading towards 2%, and they're a little bit concerned that the labor market has begun to soften. If you look at their own Taylor rule, right, about where rates should be, given this mix of unemployment and inflation, it should be at 3%, 3.5%. So there was this 250 basis point level shift that they had to undertake, and that's the way to understand this 50 basis point cut, that we may see more of it if the labor market slows in the coming months. Don't rule out another 50 in November if the labor market slows. But the point is that rates are now much above where conditions on the ground in terms of growth, inflation, the labor market are. The important part is the US is not slipping into recession just as yet. So they're cutting, in a sense, from a position of strength. This was a happy cut because inflation is coming off faster than they actually thought. What does this mean for emerging market central banks? Lata, there are going to be a lot of idiosyncratic factors. We should not rush to India. First, India. Well, let me just lay the backdrop by saying Brazil hiked yesterday by 25. Bank Indonesia cut by 25 even before the Fed. So a lot of idiosyncratic factors will matter for emerging markets. I think for the RBI, again, the news is incrementally positive, that despite a slight upside surprise to CPI last month, despite the fact that September CPI could bounce back to 4.8 or 4.9, there's more conviction now with every passing week and every passing month that food inflation is going to gap down. We've had a strong monsoon. It looks like a good sowing season. Global
so
food
for domestic reasons, you're saying?
So, but I do think the RBI will want to see a little bit more data. So we actually think in October they'll still hold their gunpowder. They'll want a little bit more conviction that, yes, food inflation after 3 years of being sticky is finally going down. And as the governor keeps saying, it's not about being at 4% for a month. It's about durably seeing 4% for the next few quarters. But this does, I'll end by saying, if the Fed cutting this year increases the odds of a soft landing in the US, that's a very good global environment for risk assets in emerging markets in 2025.
Our viewers are dying to hear what it does to Indian stocks. But very quickly, would you believe that there is still a global cloud on Indian growth? The domestic factors are pro-growth, yes, but there is a global slowdown?
No question that, yes, the US is holding up, but look at other parts of the world. There's been a lot of US exceptionalism. Europe has been soft. China continues to soften. So global growth is going to soften. And as we saw in the latest trade report, we won't get the same tailwind from exports that we have been getting over much of the last 2 years.
Okay. Well, with that, let's come to the area where we are, immediately interested in stocks. Sanjay, I read your report on how India is in a late cycle of the business cycle. First, just explain to us before I bring the Fed in.
Well, look, we've seen for the last few years in India very strong stimulus support, very strong economic growth, upgrades which are rare in India to earnings estimates and companies beating forecasts. That seems to have faded away, Lata. Right? And in
the first quarter saw downgrades.
That's right. And a significant number of downgrades, which actually is very rare for 1Q. We normally see downgrades in 3Q and 4Q towards the end of the year, but we've actually seen misses and downgrades in 1Q. We've also seen the downgrades to the GDP number, for example, as well. And that's one of the reasons we're talking about slightly late cycle dynamics in equity markets. Of course, we've stopped talking about valuations because, that signal has been flashing red for 2 years now. But in terms of growth, in terms of outcomes of companies, earnings momentum also, it does appear that we are more than through a significant upcycle in the equities market at least.
Okay, so therefore is it don't avoid equities or is it some kind of equities?
Well, that's a bit hard.
What would your preferences?
Right. So it's difficult to say avoid equities entirely because, of course, let's say if you're a local investor, Lata, this is one of the challenges.
Where else will I put my money?
Exactly. Right. With the tax incentives that we have in the economy, equities still appear relatively decent on an expected return basis, right? And it's difficult, therefore, to say you sell everything and leave the market. It's the only thing that we argue is that a lot of corners of the market are propped up principally on liquidity. And when things turn, it is that liquidity that presents a risk. See, the one thing that people forget at the top of every bubble, and we don't know when it will be, is liquidity, right? Bubbles burst because of liquidity issues. And therefore, our advice to investors is that in all of your participation, be cognizant of quality risks, right? Do not compromise on having...
Quality.
Exactly. Right. We can't
So you're never left holding a lemon.
Exactly. Because when the tide turns and you should not be unable to get out of your stock.
No, but what is a typical late cycle stock that does well? If you're in the late cycle, obviously the big growth areas, consumption should not do well. What should do well?
Well, as of now, we are overweight consumption, Lata. Okay. And this is because we've...
Both durables and FMCG?
More durables, more FMCG, I beg your pardon, for now. And this is because we expect, the K-shaped recovery that, we've had post-COVID to converge a little bit. We're starting to see a little bit of signs of it. It's still very early to kind of convincingly argue it, but there is hope that this might happen. So we are actually overweight the staple stocks.
And what else?
We like real estate, for example. We think the momentum, again, going back to the argument, where else will you put your money? The equity market benefits from it. The real estate market should also benefit from it. We are overweight healthcare. We also like, so we are not very keen, let's say, on the IT and material space as of now.
No, I would assume healthcare is a late cycle preference. It's a defensive.
It is.
I want to come back on whether the K is converging, and even slightly. But before that, Kaustubh, the big point is that FIIs are not flowing into Indian equities as much as they're even flowing into Indian debt. When you look at the data around, quite a few GEM funds are, not up to the weight they should be, rather underweight India's, weightage in, for instance, MSCI. What's your sense about how they will behave now? Do you expect that now, with the dollar also weakening, will there be a FOMO and they rush in?
I think it's true that relative to the MSCI weightage that India has, FII ownership is still, at least depending on the day, 2 to 3% lower than what it should be. But a big reason for that is the weights for India have increased meaningfully compared to where they were 3 years ago. Two, Indian market and FII, a number of the largest FIIs understanding in the Indian market was reasonably limited to around 75 to 100 of the larger liquid stocks, as Sanjay mentioned. Whereas, as we know in India in the last 3 to 4 years in particular, the breadth of the market and number of companies which have created excess returns is way, way larger than just the 75 or 100 companies. FIIs, therefore, have to go through their own recalibration and understanding of the market in India. Once they're able to do that, and that's where we are seeing so much more interest from FIIs to understand exactly what's happening. Because of the change in weightage, they have to do more work. But equally, they have to do a lot more work in terms of the complexity and the breadth of the stocks that they have to start covering. We think they are doing active work, and hopefully, I think, therefore, the money will follow once they finish the work.
Okay. I want to come to Sanjay on, the stock preferences. Aren't FIs put off by the valuations? I mean, at least in the mid-cap, do you ever see them broadening beyond the large caps?
Well, to a large extent, they have. If you look at data across Asia, Lata, the largest off-benchmark exposure for foreign investors is in India, right? Whereas in other countries, foreign investors may not even own the entire index constituents. In India, they own a far broader. It's still not a very big divergence, but at least within India, the foreign exposure off-benchmark is reasonably high. Are we starting to see interest? We do get questions from people about, hey, what's going on in this part of the market, etc. But the one sort of feedback, if I may, people are generally cognizant about valuation issues, right? And they don't want to be, like I said, be caught buying the top. And especially when
that is a deterrent.
There is a deterrent. Okay. Especially when you contrast Indian valuations to similar sectors, similar countries elsewhere, the divergence looks very stark at the moment. So I do get this resistance saying, hey, look, I'm okay with the set of stocks I have in India for now. I really can't make up my mind and convince myself to buy anything.
I want to put the incremental money. But what about large banks? I mean, Sajid is saying that if not a rate cut in October, it's somewhere there in the horizon. What does that do to your view of financials?
Well, I think most foreign investors, of course, have a decent exposure to financials already, right? And this is a legacy exposure. It's a macro view, take an economy to just go buy a set of banks in the country. That's how it's played out for many years now. And what we're seeing, of course, is banks are best placed on the valuation filter, Lata, but on the growth momentum, naturally, there has been a significant slowdown, right? In the terms of the YOY growth that you got in 22 and 23, the growth we are now getting out of banks is much more meager. So the debate you have in the investment sort of ranking, this looks great on valuation, but the growth number is perhaps no longer as exciting as it used to be. Now, our pushback is, look, relative to growth valuation or a PEG ratio.
So, may prefer NBFC in that case, no?
Yes, but NBFCs can be far more cyclical.
Okay.
Right. You have to take a cycle view, sector view, rate view, for example.
Fair enough. I have more questions on the rate view as well and what it does to bank margins. As well, there's very interesting point to make about whether the K is not widening, but probably lessening, and more important, dollar. Dollar and dollar rupee, where is it headed? All those questions to the JPM Brain Trust after the break.
Welcome back. There was some interesting conversation with the JP Morgan Brains Trust. The market continues to hold on, scale newer heights right now. While we are talking about the Nifty hitting that 25,500 mark for the first time, it's also the mid-cap index which hit that 60,000 mark for the first time. So a big milestone that we have on the mid-cap index, though it's cooled off a tad, and that is understandable as well. Just pull up the, crisscross lines, the intraday crisscross lines. You'd see them coming slightly closer. At the open, we had 1,700 stocks advancing for about 300 stocks which were declining. Now the number of stocks that are declining have tripled. So it's come to close to around 900, whereas the number of stocks which are advancing have come down from 1,700 to around 1,400 as well. So this is a trend that we'll keep an eye out on as we move towards the second half of trade and expiry, the Nifty weekly options expiry in particular as well. But more market and investment talk lined up for you. We have Anand Shah, who's the head PMS and AIF investments at ICICI Pru AMC, joining in. Anand, always a pleasure speaking with you. With the overnight Fed rate cut that has happened, what's your view on markets in general, the sectors that are likely to do well, and something that you're cautious about post yesterday?
Hi, very good morning. Thanks for having me. So I think what it does, what the rate cut does is actually it removes one overhang in the market in terms of that was one uncertainty, because very clearly, if you see, Indian economy has been okayish, but the headwinds were more from, say, China slowdown or a US rate hike, dollar strengthening, and so on and so forth. So I think this, in a way, removes one overhang that what if the dollar, the interest rates in US continues to remain high and the dollar continues to remain strong. So I think that will give little bit of respite. Nevertheless, the verdict is not yet out. If you see the response of markets post the Fed cut is also not very strong, given that the commentary is not as per the expectation, and to that extent, the subsequent cuts will be more data dependent. Coming back to India, I think India, the divergence in the various sectors in terms of performance has been very high for last 4 years. We had consumer-facing businesses sort of underperforming, IT underperforming, and the core sectors, manufacturing allied, they were doing extremely well. Now we have reached a point where most of the stocks that were to be discovered, most of the sectors that to be discovered have been sort of researched and discovered, and to that extent, the broad moves in the market would be smaller and smaller. The market cannot really move exceptionally fast and high in a short period of time, but it will be more stock specific. So what we've been telling our advisors, our investors, and even my own team, that from here on the market, within the sector also will have winners and losers. And within obviously the broader market, there will be more stock picking opportunities, which we'll have to pursue rather than the macro ideas.
Yeah, absolutely. Take that point, Anand. Hi, great to have you with us this morning. And from what I recall, across a lot of your strategies, there was a fair amount of exposure to the whole manufacturing theme, right? And now the market seems to be in a mood to kind of churn portfolios, if I could say. There's some buying in banks, obviously interest coming back in IT. So in this environment, within that manufacturing theme, what would you still hold on to, and where would you say the time has come to maybe take some money off the table? If you could explain it in a little more granular way.
No, indeed. I think we've been, overweight banking in general, which has not really played out in the last 6 months. It's been only last 1 week, 2 weeks that there's some excitement in banking, but banking remains a pick where the risk reward is fairly favorable because you have a large cap, liquid names with good quality of earnings, more stability, and to that extent, that offers you a good opportunity. Within the manufacturing, the one area which has sort of suffered the most from China's slowdown has been metals. That one area has been under serious stress in terms of profitability. The prices are coming off, and within that, the Indian metal companies have repaired their balance sheets over the last 4 years. They've been more ready for, stress on the pricing more than they were in 2020 or before. And to that extent, that metals within the overall manufacturing space is something which can look at bottom up and identify businesses which can withstand this slowdown and then benefit as the metal prices recover. Auto ancillaries remain strong in terms of opportunity, not only within India, but outside India. Many of the auto ancillaries over the last decade have sort of diversified their customer base much better than where they were 10 years back. And to that extent, they also do. But again, as I said, it's more bottom up than the top down.
Yeah, no, take that point. But, on auto ancillaries, just yesterday we were speaking to one of the companies, Suprajit, and discussing what the slowdown in the West means, because a lot of these auto anch players, they have a lot of exposure to the Western markets where sales have been coming off. Does that bother you, and how are you reading the export part of the ancillary play?
Indeed, that has been a pain for last almost 12 to 18 months. Especially the Europe has been not really doing well for many of these guys, and that's been reflected in the numbers, reflected in the stock price. So many of the auto anchs and even the bearing companies which have exposure to Europe have underperformed a lot. So both metals and auto anchs, as I said, have suffered, but any recovery in US, any stability in Europe can incrementally help them. And as I said, many of these businesses were much more vulnerable to a slowdown, say 4 years back, 5 years back, that the debt levels were high, utilizations are low. Today, many of them have repaired their balance sheet. They can withstand this slowdown, and genuinely last 18 months they have withstood this overall slowdown very well compared to what was the situation a decade. So overall, bottom-up ideas in manufacturing where people have now stronger balance sheets and more diversified customer bases
is where you need to be. By the way, I should just point out that the color is changing in the market, especially the mid-cap screen. Look at this. We've got red on mid-cap. So the sense of caution is very much prevalent even here in India. It wasn't just the volatility in the US market. See that changing very, very quickly. Where's the money coming off? Quite a few of the PSU stocks, by the way. RVNL, IRFC, PFC, IOB, REC, Central Bank of India, you get the drift. So PSUs is where the money is coming off. And some of the other names like, the more active names like an IRB, Infra, NIIT, some red on these stocks as well.
Well, there was a mild dip in gold as well overnight, and as a result of which we've seen some of the stocks which have higher exposure to unhedged gold coming off too. So PN Gadgil, for instance, is down 5% now, had a stellar listing in the earlier part of the week. And then we have BSE as well, a big mover in yesterday's trading session, now seeing a sharp bout of profit, taking down about 6%. So negating, a large part of yesterday's up move that happened as well. But back to Anand, one of the stocks which has been in focus today among the top gainers is NTPC. The street was expecting value unlocking through its renewable, subsidiary, and that's something that is happening. You hold this stock. I mean, how much of it is in the price right now?
No, so again, stock specific is difficult, but overall, look, last couple of months have been tough, especially with good monsoons. Electricity demand has sort of softened. And to that extent, generally the segment where we were looking forward to a significant deficit of power, and to that extent, we had strong up move in across the power sector, both generation, distribution, and T&D. We have seen some softening there. But our take is that given that manufacturing is picking up, given even the electricity penetration will go up and the consumption of electricity at the household level will go up, we remain constructive on the power segment as a whole, generation, distribution, as well as T&D.
Okay, Anand, we'll leave it there. Thank you very much for your time. Pleasure speaking with you here on CNBC TV 18 this important morning. So that's essentially what we have as far as the market view is concerned. By the way, I have to say that, and Surabhi was pointing out the mid-cap space, overall market breadth has also flipped into the negative. I mean, this is overall NSE. You've got about 1,250 stocks down now, and you've got about 1,140 stocks which are higher at this point. And the biggest loser is Bajaj Housing. The biggest volume-led loser is Bajaj Housing, is down 7%. Stocks at about 161 at this point in time. And you've got BSE, of course, which had a one-way kind of a move. At the highs, recent highs, BSE's market cap had reached almost about 20% of NSE's implied market cap, at about 5,500 rupees a share. Ola Electric, recent listing, and of course, there were two initiations. Stock went up day before, 3% lower here. Nazara is down sharply, 4.5%. That fundraise yesterday, 1,040. So yeah, I mean, it's kind of more and more into the mix as we sort of finish and we get closer to the first hour mark as far as markets are concerned. Well, you know, we've been talking about rates in the US and how perhaps the Fed has kicked off a global easing cycle. Let's bring it down to India and get a perspective on, you know, what we should expect on rates here in India, and of course what the impact on financials really is. Remember, the neutral rate in India is estimated to be between 1.5% to 2%. RBI's target inflation is 4%, and RBI is not expected to start to cut rates. I mean, is expected to start to cut rates only by about December of this year, maybe a few 25 basis points from that point on. We have the former RBI Deputy Governor, Mr. S.S. Mundra, is joining us. We have Param Subramaniam, Vice President, Equity Research, Banks and Financials. He's with Nomura. Gentlemen, great to have both of you here. Thank you very much for your time. Mr. Mundra, if I can start with you. So, you know, the Fed's cut, when do we start to see the cut here in India? And in your experience, I mean, is this a big global easing cycle on the downside? How does it typically play out? Go
on. Thanks for having me here. If I look at it, actually, 50 basis point cut has come as a surprise, little bit of surprise. But if we look at the US scenario, I think all the forecasters were expecting a 25 basis point cut. But market were already probably building in a 50 basis point cut. That was the scenario before the Fed meeting. Now, with this 50 basis point cut, probably what Fed is signaling that maybe they are comfortable with the trajectory of inflation. They are also factoring in the fact that while inflation is at 2.5%, but there would be lag impact, and it will be on course. And probably focus is on now employment and growth. Interestingly, the expectation, the forecast of a recession in the US has significantly increased in last 1 month. I think from almost 50% to 61%, and that is the trigger. But there is an interesting point between the India and the US. While in India, the consumer inflation is well on lower trajectory, but the core inflation is stubborn. In India, the situation is exactly reverse. The consumer inflation is stubborn, while the core inflation, in fact, part of it has even moved into the deflationary category. Anyway, my view is, or I would say, expectation would be, desire would be that probably RBI now would move with a 25 basis point cut in its next policy announcement. There had already been a significant divergence of view in the MPC. Of course, we would have a new MPC, new members, but I would expect that this 25 basis point cut, where the RBI would also factor in that there will be some lag impact. If you read the inflation reading in the nearest month, that is the July and August, it is already below 4%. Of course, RBI will take a longer view, would like to look how the trajectory is in next 6 to 12 months. But I think looking to the overall environment, looking to the Fed action and looking to the data point, which is emerging within India, also slowdown in both consumers facing activities as well as the investment facing activities.
Right.
There is a sign of some slowdown. Probably a 25 basis point cut would be a thing to go for.
Okay, got it. Thanks for sort of putting it clearly, Mr. Mundra. Param, if I can come to you. Good morning, Prashant here. What's the impact on financials here in India? If you can go segment by segment. And are there any plays here from a stock perspective? Go on.
Yeah, sure. Thanks, Prashant. Good morning to all your viewers. So yes, from a rate cutting perspective, if you look at it for the banks from a margin perspective, remember in this cycle, it's different from previous rate cutting cycles because banks have a large portion of their loan books directly exposed to external benchmarks, and so when the rate cuts do happen, there is a negative pressure that will come through on bank margins as well as their ROAs. The rough math we have is that about a 50 basis point rate cut by the RBI will translate to about a 15 to 20 basis point negative impact for the large private bank margins. At an ROA level, it probably comes down to something like 7 to 10 basis points, right? Some of the smaller banks, mid-cap banks that have higher fixed rate exposures, they have a lower, say, negative impact on their margins and their ROAs. But you also have to take into account the fact that some of these smaller banks also have exposure to riskier segments, be it microfinance, be it personal loans that have been in focus from, say, an NPA perspective for the sector as a whole. Now that's the first order impact. From a second order perspective, you also have to take into account that rate cuts generally do bring in easier liquidity, and that has been one of the constraints for the sector as a whole. So when you have, say, an easing money supply, that will also help the banking sector from a growth perspective as well. And generally, in 2 out of the 3 last rate cutting cycles, we've actually seen CASA ratios for the sector as a whole also improve. Now we've seen sharp deterioration in the CASA profiles across the banks over the last 2 years. But at the margin, if you are moving into an accommodative phase, one would expect that you don't need to be very negative on this front. From a positioning perspective, we are more towards the large private banks at this stage. So the names we like are names like Kotak Bank, ICICI, among the large privates. We also like SBI among the PSUs, and within the mid caps we like a federal bank. We don't see a need to move down the risk curve. Of course, there is a margin level pressure, but to play that, we don't see a need to move down the risk curve as the sector as a whole is pretty cheap, from a historical valuation standpoint.
Well, Param, quickly, do NBFCs, because the liability side has been the problem for a lot of NBFCs, liquidity has been tight, larger ones can raise, go overseas, etc., smaller guys cannot. Do you think, from an investor perspective, NBFCs and some of the smaller ones stand to benefit as well?
Yes, of course. So the NBFCs are natural beneficiaries, and the way we would look at it is to look at NBFCs that don't have problems, at least from a credit cost or NPA formation perspective. And from that standpoint, we are more in favor of some of the secured NBFCs, which will have the the margin benefit tailwind as well as the liquidity easing tailwind, but not as much of the credit cost pressure. And from that perspective, the names we like are names like Shriram Finance. Within the affordable housing space, Aadhar Housing is something our analyst likes. And we also like a small SME focused lender called 5-Star. So I think that's the way to look at it. Secured NBFCs is of course a key beneficiary. Yeah.
Okay. Got that, Param. I'll stay on some more questions in a bit. Mr. Mundra, if I could come back to you, sir. You said that in all probability, maybe we'll see 25 basis points from the Reserve Bank of India. But let me ask a wider, broader question. Apart from the fact that, one of the biggest central banks in the world is now on a cutting cycle, does the RBI really have any reason to move on rates at all? Because inflation, consumer inflation, like you rightly pointed out, sir, is very, very sticky. And the governor has been always in his commentary mentioning that there's a hawk eye on inflation and we can't sort of, lift the foot off the pedal there. And on the other side, growth is not really faltering in India. So is there a need to move on rates at all? The RBI could perhaps look at liquidity measures instead of rates, could it not?
No, you are very right. And probably that is why I say my desire would be, I never said that RBI would cut. That was not an emphatic statement. I said my desire would be that there should be a cut. No, the point is, as I mentioned, in the recent month, the inflation reading is below 4%, while growth is strong. But if you again look from the recent month, both on the consumer-facing business as well as the investment-facing businesses, there had been a slowdown. So I think while growth is continue to be good, but it continue to remain below potential. So I think that is where the tipping point is. And that is why I said that probably now there is a room because, if with US 50 basis point cut and India remaining where it is, I think the RBI would have to face another problem, is a tricky part. And that would be probably the inflows coming, rupee appreciating, which can create problem for the export sector, which has already seen, some discomfort in the recent month. So I think this is where the, balancing factor is there. And that is why I said probably RBI and within MPC also, there is a divergence of view now for quite some time. So maybe probably this time RBI may prefer to start a cycle or at least giving a signal. Of course, it could be either a rate cut or it could be, as you rightly said, there could be liquidity measures, there could be some other indication or even the stance may change. But some action would certainly emerge. This 50 basis point cut by Fed cannot be completely go unnoticed in the RBI's policy announcement. That is my point.
That's a fair point. Thank you so much for laying down the thought process of the RBI, what your desire is and what the expectations are from the street as well. Mr. Mundra, Param also talking about the stocks that you like and the sector which is little, still has some value on offer as well. Insightful discussion this. What we'll do is take a short break with the news that the mid-cap index sell-off is now exacerbated, down almost 2/3%. And the advanced decline has flipped completely. 1,500 stocks declining for just about 900 stocks which are advancing. A lot of stocks seeing a firm amount of sell-off, though no problems for the Nifty Bank, which still holds its head above that 53,000 mark. We'll keep an eye out on the markets and a lot of individual stocks and the commodity space as well after this short break. Welcome back. Even as the mid-cap index is seeing some sell-off, a couple of stocks doing extremely well. Gillette is the one that stands out, has moved to the high point of trade, and that's largely on account of positive commentary coming in from its analyst meet yesterday. The street likes the prospects of growth, and their market share in the grooming segment has been the highest ever in 2024 itself. But that's about the equity markets. Let's talk about the commodities market. Manisha, after what took place overnight by the Fed, what's the commodity that you're tracking today?
Well, I'm looking at the whole gamut, by the way. There was a knee-jerk reaction as soon as the 50 basis point rate cut came in. And that is because the commodity markets, well, they trade for 22 hours in a day, somewhere across the globe. And we saw immediate reaction come in for this one. So $2,600 an ounce is what the gold price is. Immediately gave you on screen after that. But since then, it has been a bit of a profit taking into the markets. And that is because the dollar index and the bond yields also gained up. This is after the US Fed future guidance, where Jeremy Powell said that the Fed is not in a rush to continue to ease policy, and 50 basis points is not going to become a norm there. 25 basis points in the next two meetings is what the street is now working with, and that is something that the gold as a commodity or a wealth has already factored in. But what really seems to be working right now is that we already have seen ECB cut interest rates. Hong Kong cut interest rates by 50 basis points. And now the street will watch out for Bank of England and Bank of Japan monetary policy meeting in this week itself. So if you have this continued global cycle rate cut continuing, that could bring support back in case of gold prices. Western part of the world is looking at a lot of gold buying in physical sense, bonds and ETFs as well. If you look at the global ETF market itself, for the last 3 and 4 months, we've seen net inflows come into the space. Also, the net longs on COMEX gold are at the highest since 4 years. So that tells you that the long ads have just about continued. And any profit taking that we've seen in case of gold hasn't been more than $50 or $70. And that's exactly what we already have seen since the market went up. Industrial commodities as well have seen that knee-jerk reaction after the rate cut. But since then, in the New York session itself and the Asian markets right now, we have seen a bit of a decline. A 50 basis rate cut also tells you that the US perhaps is concerned about a slowing economy. Also, the kind of data that we have seen come in from China has all been on the weaker side. Unemployment numbers, retail sales, production, fixed assets, home prices, everything has seen a decline. So the street believes that going forward, perhaps China could come out with more stimulus measures and that would be supportive. But at this point in time, we haven't seen all of that work. So crude oil prices also have seen a decline while it is still trading at around $73. But remember, crude has seen a decline of 13% already in this quarter. And we also have seen the US crude inventories surge to by nearly 1.6 million barrels as the data came in yesterday, and that is weighing on. Within the metal space, zinc, copper fell by 1% overnight. If you look at aluminum, tin, they fell by 0.5% as well. So the only thing that the street will watch out now is if there is a China stimulus coming and what will Bank of England and Bank of Japan do now in this week.
All right, take that point, Manisha. Thanks a lot for that. From the Fed, it's over to the Bank of England and Bank of Japan. The impact of that on the commodities as well. We take a short break on that. On the other side, as always, our special segment, It's the Economy. Lata will get chatting with Chetan Iyer, Chief Asia Economist, Morgan Stanley, to decode India's growth picture. Stay tuned for that one.